Okay, let's unpack this. We've got, well, a pretty substantial stack of material here, really digging into the fundamentals of the Indian economy.
Mm-hmm.
We're talking everything from national income and poverty, right through to banking, fiscal policy, trade, taxation, the whole lot.
It's definitely dense material. Vital stuff, though, for understanding how it all works.
Absolutely. And it's complex, no doubt, but understanding these basics is so important for getting how the economy operates and, how it affects you.
That's right. The sources cover the core concepts, the policy tools governments use or try to use, and some of the really big challenges India faces.
So our mission in this deep dive, using only these sources, is to cut through that complexity, pull out the key ideas, maybe some surprising bits.
And connect the dots, show how these different pieces fit together.
Exactly. Give you a clearer picture.
Because the Indian economy is so dynamic, understanding these principles, the government's toolkit, it's really valuable for making sense of the daily news.
Right. Let's jump in. So maybe just to frame the big picture first. Economics has these two main branches, right? Micro and macro.
Yeah, exactly. Microeconomics is like zooming in. It's about the decisions of, say, individual households or single firms. Why do you buy something? Why does a company hire someone?
Small-scale decisions.
Right. And macroeconomics is the wide-angle lens.
Looking at the whole system.
Precisely. It looks at the economy overall, the big aggregates like total national income, inflation across the country, employment levels, the big picture trends.
Okay, that sets the stage. Now, staying with micro for a second, one concept that's crucial for businesses and governments actually is elasticity.
Ah, yes. Demand elasticity.
We know the basic law of demand: price goes up, demand usually goes down. Smartphones getting cheaper is the good example, all else being equal, of course.
Right. But elasticity tells you how much that quantity changes in response to the price change.
How sensitive it is.
Exactly. Is demand highly elastic, meaning a small price change causes a big shift in how much people buy? Or is it inelastic, where even a big price change doesn't affect demand much?
And this isn't just theory, is it? The sources link it directly to revenue.
Absolutely not theoretical. It's critical for businesses. If demand for your product is elastic, raising the price could actually lower your total revenue.
Because you lose too many customers.
Right. But if it's inelastic, raising the price increases your total revenue. Understanding that is, well, fundamental for pricing.
And governments use it too.
Yes, the sources mentioned they use elasticity concepts when modeling the potential impact of new taxes, for instance.
Okay, interesting. Now let's zoom out. From individual products to the whole country, how do we measure the economic health, the output of an entire nation? That's national income.
National income is basically the value of all the goods and services a nation produces in a year. It's a core indicator. Policymakers use it constantly to gauge performance and, well, try to measure well-being to some extent.
And the headline number we always hear is GDP, gross domestic product.
Yes, GDP. The sources define it a couple of ways. You can think of it as the sum of the gross value added the value added by each firm in the production process.
Okay.
Or, perhaps more commonly understood, it's the total money value of all final goods and services.
Final meaning not the components used to make something else.
Exactly. The finished product, produced within the country's geographical borders in a specific accounting year. And there's a link. GDP at market prices equals the total GVA plus net product taxes.
It's quite something that people were trying to estimate this even before independence.
Oh, yes. Figures like Dadapai Naroji made early attempts, though the data was very limited then. Post-independence, a key step was the National Income Committee, with people like Mahalanobis, Gadgil, VKR Rao setting up a more systematic approach.
GDP is the main one, but the sources mention others like GNP and NP.
Right. Gross national product, GNP, includes income earned by residents from abroad. Net national product, NNP, takes GNP and subtracts depreciation.
Depreciation being the wear and tear on things like machines and buildings.
Exactly. Accounting for the capital used up in production, so NNP gives a slightly different perspective. But GDP tends to be the most cited figure.
How is it calculated in practice? The sources focus on the expenditure method.
Yeah, that's a common one.
Right.
It basically adds up all the spending on those final goods and services. The formula is often shown as GDP plus I plus G plus NX.
C for consumption, I for investment.
G for government spending, and NX for net exports, which is just exports minus imports.
So it tracks who's doing the buying: households, businesses, the government, or people overseas.
Precisely. And the sources note this method is often used because, relatively speaking, the data on spending is more readily available.
Now, for this data to be meaningful over time, the base year they use for comparison is really important, right? And it needs updating.
Crucially important. The base year acts as the benchmark. If the economy structure changes significantly, new industries emerge, old ones decline. The base year needs to be updated to reflect that reality, ideally every 5 years or so.
India's last change was a while back now, wasn't it, 2015?
Yes, shifting the base from 2004-05 to 2011-12. Then there was another revision discussed for 2017-18 to improve data coverage and how taxes were handled.
So the key takeaway is that when you see growth rates, you need to know which base year series it refers to, because they might not be directly comparable.
Absolutely. It can affect the headline growth numbers.
Okay, so GDP is the standard measure. But the sources bring up this idea of green GDP. What's that about?
Green GDP is an attempt to adjust the traditional GDP figure. It starts with GDP, but then tries to subtract the estimated costs of environmental damage.
Like pollution, resource depletion.
Exactly. Costs associated with using up natural resources or degrading the environment. It acknowledges that economic activity often has environmental downsides that standard GDP ignores.
Which points to a broader limitation of GDP, doesn't it? It's not a perfect measure of actual well-being.
Not at all. That's a key point in the sources. GDP measures economic activity, production. But it misses a lot. The informal sector, which is huge in India, isn't fully captured.
Bartering unpaid work.
Right. Non-monetary exchanges are out. And crucially, externalities aren't priced in.
Externalities being?
Side effects, basically. Like pollution from a factory that production might boost GDP, but the pollution harms welfare. That cost isn't subtracted from GDP. Or positive externalities, like the benefit to society of having a well-educated population, might not be fully reflected in GDP either.
So, national income figures like GDP are vital tools for policy, for understanding the scale of the economy.
Indispensable, really.
But we have to be careful. They have limitations, issues with capturing the informal economy, environmental costs, and overall well-being.
Precisely. You need to look at them alongside other indicators. Per capita income growth gives a better sense of individual improvement, but even that's not the whole story.
And that leads us neatly into some of the major socioeconomic challenges the sources cover: poverty, inequality, and unemployment. These really get at who benefits from that GDP growth.
They're deeply linked, these three. Starting with poverty, the sources talk about absolute poverty, basically, not having enough income to afford the bare minimum necessities: food, shelter, healthcare.
Measured against a poverty line.
Yes, a minimum income or consumption level needed for that basic standard of living. And as the sources note, this line can vary even within India because prices differ from place to place.
A common measure is the headcount ratio, right? The percentage below the line.
That's the HCR, yes. But its limitation, which the sources point out, is it tells you how many people are poor, but not how poor they are.
Someone just below the line counts the same as someone far below it.
Exactly. If the poorest get even poorer, the HCR might not change.
India has used various committees over the years to try and estimate poverty levels.
Indeed. The Lakdawala Committee, back in the day, used calorie intake based on consumption surveys. Later, the Tendulkar and Rangarajan committees updated methods and data, trying to get a more accurate picture as the economy changed.
But poverty isn't just about money, is it? The sources bring in the Multidimensional Poverty Index, the MPI.
Right. This is a much broader view. The MPI says poverty isn't just lack of income, but also facing multiple deprivations at the same time in health, education, living standards.
Like lack of clean water, or sanitation, or kids not going to school.
Exactly. It looks at these overlapping deprivations. Developed by the UNDP and OPHI, it gives a richer picture of what they call acute poverty. The global figure mentioned for 2023, over 1.1 billion people, shows the sheer scale of this issue worldwide.
The sources do mention significant progress in poverty reduction in India, though, attributing it partly to growth but also to social schemes.
Yes, they suggest fast economic growth can help lift people out of poverty, but they also stress the ongoing need for specific, targeted programs for relief and support. Progress is noted in areas like nutrition, sanitation, access to cooking fuel, financial inclusion. Many of the MPI dimensions, actually.
A different data source for understanding deprivation is the Socioeconomic Caste Census, SECC 2011. How does it differ from older poverty counts?
SCCC looked beyond just income or consumption. It tried to capture various household deprivations directly. This allows for better targeting of welfare schemes using specific exclusion and inclusion criteria like automatically included or excluded groups based on deprivation indicators. The Summit Bose Committee recommended using this data for identifying beneficiaries.
What about potential solutions? Universal Basic Income, UBI, gets a mention.
Yes, the sources touch on the UBI debate. Arguments in favor mentioned include empowering individuals, creating a safety net, maybe addressing job losses from automation, stimulating demand, and promoting social justice. It's presented as one potential policy tool being discussed.
Okay, let's shift to inequality. The World Inequality Report 2022 paints a pretty stark picture for India.
It does. It highlights India as one of the most unequal countries globally. That finding about the top 1% holding about a fifth of the total national income is, well, it's a very striking figure.
And that other data point, needing only hours 25,000 a month to be in the top 10% of incomes back in 2019-20, really underscores the income disparity, doesn't it?
It does. It suggests a large concentration of people at the lower end of the income scale. And the labor market structure plays into this. The largest group is the self-employed, and they are disproportionately found in the lowest income categories.
So what's being done? Government initiatives mentioned include
Things like land reforms historically, laws to curb monopolies like the MRTP Act and later the Competition Act, employment generation schemes like MGNRGA, and using progressive taxation where higher earners pay a higher percentage of tax.
Let's drill down on unemployment now. The sources make a distinction between the labor force and the workforce.
That's an important technical point. The labor force includes everyone who is either working or actively looking for work and available to work. They are potential participants.
Yeah.
The workforce, on the other hand, includes only those who are currently employed. So the labor force is always bigger than the workforce, and the difference is the number of unemployed people.
Right. And the sources clarify that some people, like beggars, aren't counted in the workforce definition.
Correct. The main metrics are the number of unemployed and the unemployment rate, which is the number of unemployed as a percentage of the labor force.
And there are different types of unemployment.
Yeah, cyclical, which happens during economic downturns. Chronic, which is long-term due to lack of skills or opportunities. Technological, where machines replace workers. And casual or seasonal unemployment.
One figure that really jumps out from the sources is the sheer scale of informal work in India.
The CMIE survey figure for 2022-23, 84.9% of the workforce in the informal sector is huge. It means the vast majority operate outside formal contracts, regulations, and Social Security benefits. It's described as stubbornly high.
And the sources suggest a link between the post-1991 market reforms and this high level of informalization.
They mention a correlation, yes, that the shift towards a more market-driven economy might have contributed to this trend.
There are also gender differences noted in where people work and, encouragingly, a decline in the overall unemployment rate in recent years, including for women.
Yes, some positive trends there. And MGNRGA is highlighted as a key policy intervention.
The Rural Employment Guarantee Scheme.
Right, aiming to provide at least 100 days of wage employment to rural households who demand it. It acts as a crucial safety net, and its funding was boosted during the pandemic. Efforts to provide Social Security for gig workers are also mentioned, reflecting how the nature of work is changing.
So wrapping up this section on socioeconomic challenges, poverty, inequality, unemployment are all major interconnected issues.
Deep disparities persist. It's not just one problem with one solution.
The sources suggest it needs sustained investment in things like education, healthcare, rural development.
Absolutely. Plus, policies focus on creating inclusive jobs and achieving a more equitable distribution of wealth. It needs a multi-pronged attack, as the sources put it. And that idea of seeing the poor not just as victims, but as potential entrepreneurs, as Prahalad suggested, seems key.
Okay, let's move on to the government's toolkit for trying to manage the economy and address these issues. We're looking at planning, fiscal policy, and monetary policy.
Right. Economic planning in India really took shape after independence. It was seen as a way to systematically guide the economy towards goals like growth and social welfare, given the context of the time.
Which was?
A largely agrarian economy, issues with land ownership, the legacy of colonial policies that had hampered domestic industries. There was a perceived need for a directed approach. The Planning Commission was set up in 1950.
The sources mentioned different types of planning.
Yes, comprehensive planning, which is very state-controlled, like in old centrally planned economies. Indicative planning, where the state guides and facilitates rather than commands, more suited to mixed economies. And perspective planning, which sets long-term goals, say 15, 20 years out, broken down into shorter 5-year plans. NITI Aayog, which replaced the Planning Commission, uses this long-term perspective approach.
And this evolved over time. Early ideas focused on industrialization to fight poverty.
Yes, like the Visvesvaraya plan. And even business groups like FICCI advocated for national planning back then. A major shift, though, was the Rauman Mohan reforms in the early 90s.
The LPG reforms, liberalization, privatization, globalization.
Exactly. That marked a significant move away from the earlier, more state-led model towards more market-oriented approach, reducing controls and opening up the economy.
The 5-year plans continued for a while, though. The sources mentioned the goals for the 11th and 12th plans, focusing on faster and more inclusive growth.
Right. Then came NITI Aayog in 2015. Its role is described as more of a think tank, promoting cooperative federalism, coordinating goals like the SDGs, fostering innovation, generally a more flexible advisory role compared to the old Planning Commission.
A big goal mentioned in the sources is reaching a $5 trillion economy.
It's an ambitious target. The sources highlight opportunities like India's demographic dividend, that large young population, and the potential of digital transformation.
But also significant hurdles.
Yes, the challenges we just discussed, inequality, job creation, the need for financial sector reforms, bureaucratic issues, environmental sustainability, are all flagged as critical obstacles to achieving that $5 trillion goal in a way that benefits everyone.
Which brings us back to that term, inclusive growth. What does it really mean according to these sources?
Citing bodies like the OECD and UNDP, it's defined as growth that's distributed fairly across society, creating opportunities for all segments. It's not just about the GDP number going up.
It's broader.
Much broader. It includes access to essential services like health and education, empowering marginalized groups, ensuring environmental sustainability, good governance. It's multidimensional.
Indices like the WEF's Inclusive Development Index try to capture this.
Yes, looking beyond just GDP growth. And government initiatives cited as aiming for inclusive growth include things like Digital India, specific programs for marginalized communities, investing in social infrastructure. Disha project for women entrepreneurs is one example mentioned.
The metaphors used, unleashing the entrepreneurial spirit, a rising tide lifts all boats, point towards this broader vision.
And that Prahad quote, again, viewing the poor as potential entrepreneurs and consumers.
Okay, let's shift to the second major tool, fiscal policy. This is about government taxing and spending, right?
Exactly. Using the government's budget, its revenue collection and expenditure to influence the economy. The objectives are broad. Allocating resources, trying to reduce inequality, maintaining stability, boosting employment, managing debt.
The components are government revenue taxes and non-tax sources.
Expenditure, what it spends money on, divided into revenue day-to-day, and capital asset building spending.
And public debt, how much it borrows.
Right. And governments can deploy this policy differently. Expansionary policy is increasing spending or cutting taxes to boost a sluggish economy.
Injecting demand.
Yes. And contractionary policy is the opposite, cutting spending or raising taxes to cool down an overheating economy, maybe fight inflation.
But it's not always straightforward in practice.
No, the sources mention constraints, data limitations, time lags before policies bite, needing political support, and the global economic situation all play a role.
How does the budget actually get made in India?
The budget division in the Ministry of Finance leads the process. The finance minister presents the annual financial statement, the budget, to Parliament, as required by the Constitution, Article 112. It then goes through several stages of parliamentary scrutiny, discussion, and voting before being approved. The financial year runs April to March.
The classification of spending changed, didn't it, from plan versus non-plan?
Yes, until 2017 it was plan on plan. Based on recommendations, it shifted to classifying expenditure as either capital or revenue. The idea is to get a clear picture of what spending is building long-term assets versus covering running costs.
And there's this outcome-output monitoring framework, OMF.
This aims to track not just how much money is spent, but what is actually achieved with it, the outcomes. It's about improving efficiency, effectiveness, transparency, and accountability, making sure tax money delivers results.
Gender budgeting also falls under fiscal policy.
Yes, it's about analyzing the budget's impact specifically on women and men and whether it helps reduce gender inequalities. Special cells are supposed to do this analysis.
But the sources mention some challenges with it.
Yeah, criticisms include a potentially shrinking share of the budget allocated specifically for women-centric schemes, delays in implementation, spending being bunched up at the end of the financial year, the March rush, and maybe not always aligning with long-term gender equality goals.
The sources also explain the different government accounts: consolidated fund, public account, contingency fund.
Okay, the Consolidated Fund of India is the main one. Think of it as the government's primary account. All revenues, taxes, loans taken go into this fund. All government expenditure is met from here. Crucially, money can only be withdrawn after getting parliamentary approval.
And the CAG audits it.
Yes. Then there's the public account. This is different. Here, the government acts more like a banker, holding funds that belong to the public but are temporarily deposited with the government.
Like provident funds, small savings.
Exactly. Withdrawals from this account are for specific purposes related to those funds and don't need fresh parliamentary approval each time.
And the contingency fund.
That's for emergencies. An imprest held by the president to meet unforeseen expenditure. Advances can be made, but Parliament needs to authorize the expenditure later.
Let's talk deficits. Revenue deficit.
That's when the government's day-to-day running expenses, revenue expenditure, exceed its regular income, revenue receipts. It means the government is essentially borrowing to cover its operational costs. Not ideal, as it can increase the debt burden without creating assets.
And the fiscal deficit. That's the big one usually reported.
Yes. Fiscal deficit is the difference between the government's total expenditure and its total receipts, excluding borrowings. It shows the total amount the government needs to borrow in a year. It's a key indicator of the government's overall financial health and borrowing pressure.
There's also primary deficit.
Primary deficit is the fiscal deficit minus the interest payments on previous borrowings. It gives a sense of the current year's fiscal imbalance, ignoring the legacy of past debt. The effective revenue deficit concept is also mentioned, trying to adjust for grants that create assets at the state level.
To manage these deficits, there's the FRBM Act, Fiscal Responsibility and Budget Management Act, 2003.
Right. This provides a legal and institutional framework aimed at ensuring fiscal discipline and prudence. Its goals are fiscal consolidation, long-term macroeconomic stability, and intergenerational equity, not burdening future generations with excessive debt. It set targets for reducing deficits, though these have been revised over time. The Act also mandates transparency through specific fiscal policy statements presented with the budget.
The idea of an independent fiscal council comes up in the sources, too.
Yes, the debate around creating an independent body to assess the government's fiscal plans and forecasts. Pros mentioned include potentially enhancing credibility and discipline. Cons include cost, finding the right expertise, and potential conflicts with the government.
And finally, on fiscal matters, how funds get from the union government to the states.
Key routes mentioned are grants based on the Finance Commission's recommendations, which constitutionally determines tax-sharing principles. Specific grants for things like disaster management and various sector-specific grants, sometimes linked to performance.
Okay, that covers fiscal policy. Now, the third big tool, monetary policy. This is the domain of the central bank, the RBI, and it starts with money itself.
Right. Money is defined by its functions. A medium of exchange, a unit of account, a store of value. It makes transactions possible, allows us to compare value, and hold purchasing power over time. It's evolved dramatically, of course.
The sources even briefly mention cryptocurrency.
Yes, touching on its pros like decentralization and security, but also highlighting major cons like volatility, lack of consumer protection, and limited acceptance. Digital currencies in general are noted as evolving forms of electronic cash.
Central to monetary policy is the money supply.
This is the total stock of money circulating in an economy at a given point in time, includes currency with the public and various kinds of bank deposits. Managing the money supply is a key task for the RBI.
The sources mention different measures, M1 to M4. What's the basic idea there?
It's about liquidity, basically. M1 is the narrowest and most liquid measure. It's currency held by the public, plus demand deposits, like current accounts. Very easily spent. As you go to M2, M3, M4, you add progressively less liquid forms of money, like savings deposits and time deposits. So M4 is the broadest measure. RBI tracks these different aggregates.
And high-powered money or reserve money?
This is the monetary base, sometimes called M0. It's the currency in circulation plus the reserves held by commercial banks with the RBI and their vault cash. It's the money directly created by the RBI and the government, coinso and rupee notes. Changes in reserve money have a multiplier effect on the broader money supply.
The Reserve Bank of India, RBI, is central to all this. What are its main roles?
Oh, they are extensive. It's the monetary authority formulating and implementing policy. It's the regulator and supervisor of the financial system banks, NBFCs. It issues currency, it manages foreign exchange reserves, it oversees payment and settlement systems, and it promotes financial inclusion, a huge mandate.
What about RBI autonomy? It's often discussed.
Crucial for credibility, especially for controlling inflation. The idea is the central banks should operate independently from short-term political pressures. However, the sources note it's not absolute independence. Section 7 of the RBI Act allows the government to give directions to the RBI in the public interest after consultation. So there's a legal provision for government influence, though it's rarely invoked.
India's monetary policy framework itself has changed quite a bit over the decades.
Significantly. In the early decades post-independence up to the mid-80s, it relied heavily on direct instruments controlling interest rates directly, setting high reserve requirements, CRR, SLR, allocating credit. This was often seen as an era of fiscal dominance, where monetary policy supported government borrowing needs.
Then a shift.
Yes, from the mid-80s to late 90s, based on the Chakravarti Committee recommendations, India moved towards monetary targeting, trying to control the growth of money supply aggregates like M3.
Why did that change?
Because the relationship between money supply and inflation became less stable and predictable, partly due to financial liberalization. So from the late 90s until 2016, the RBI adopted a multiple indicators approach, looking at a wider range of variables, inflation, growth, exchange rates, fiscal position, etc., to guide policy.
And the current framework since 2016.
That's flexible inflation targeting, formalized by amending the RBI Act. The primary explicit goal now is price stability, defined as keeping CPI inflation at 4% with a tolerance band of plus minus 2%. While keeping the growth objective in mind, inflation targeting is the anchor.
Decisions are made by the Monetary Policy Committee, MPC.
Yes, a 6-member committee, 3 from RBI, 3 appointed by government, that decides on the key policy rate, the repo rate, needed to meet the inflation target.
Let's quickly run through the main tools the RBI uses, as mentioned in the sources: CRR and SLR.
Cash reserve ratio, CRR, the fraction of banks' deposits they must hold as cash reserves with the RBI. Changing this directly impacts the amount of funds banks have available to lend. Statutory liquidity ratio, SLR, the fraction of deposits banks must hold in safe, liquid assets like government securities, gold, or cash. This ensures solvency and influences credit availability.
The LAF liquidity adjustment facility seems central.
Very much so. For managing day-to-day liquidity, it involves the repo rate.
The rate at which banks borrow overnight from RBI against government securities.
Exactly. It's the main policy signal. And the reverse repo rate, the rate at which RBI borrows from banks. The LAF corridor helps stabilize short-term money market rates.
Almost open market operations.
That's the RBI buying or selling government securities in the open market.
Right.
Buying injects liquidity, selling withdraws it, a very flexible tool.
Other tools mentioned include the Marginal Standing Facility, MSF, for emergency overnight borrowing by banks at a slightly higher rate.
The bank rate, which is more of a signaling rate now for longer-term loans.
Market Stabilization Scheme, MSS, to absorb excess liquidity, specifically arising from large capital inflows.
Right, by issuing special government securities. And priority sector lending, PSL.
That's the mandate for banks to lend a certain percentage to specific sectors.
Yes, sectors like agriculture, MSMEs, education, housing. RBI sets targets. It's a tool aimed more at credit allocation and financial inclusion than purely managing liquidity or inflation. Banks can co-lend with NBFCs for PSL targets, too.
What about the impact of inflation itself?
Well, the most obvious is it erodes purchasing power, your money buys less. The sources mention the shoe leather cost. When inflation is high, people try to hold less cash, make more frequent trips to the bank, wearing out their shoes metaphorically.
And taxes.
Inflation can push people into higher income tax brackets even if their real income hasn't risen. That's bracket creep. And indirect taxes often rise automatically as prices go up.
How is inflation measured? WPI versus CPI.
Wholesale Price Index, WPI, tracks prices at the wholesale level. It used to be the main inflation measure, but excludes services and indirect taxes. Consumer Price Index, CPI, tracks retail prices paid by consumers. The CPI combined, CPIC, covering both rural and urban areas, is now the key metric for RBI's inflation targeting because it better reflects the cost of living.
The sources also list types of inflation based on speed.
Yeah. Creeping, low, single digit, Galloping, double, triple-digit, hyperinflation out of control. And concepts like core inflation, excluding volatile food energy, deflation, falling prices, disinflation, slowing inflation rate, stagflation, inflation plus recession, and the inflation tax, loss of purchasing power for money holders.
So the RBI uses this complex toolkit, guided by the inflation target, to navigate the economy.
It's a continuous balancing act, trying to keep inflation stable while supporting sustainable growth.
Okay, let's dive into India's financial ecosystem itself. The banks, the markets.
It's a really diverse landscape, as the sources highlight. Public sector banks, private banks, foreign banks, cooperative banks, specialized institutions like development banks, all regulated primarily by the RBI. It's a reflection of that mixed economy approach. And this system is the plumbing, essentially, channeling savings into investment, providing credit, crucial for growth.
Banking saw huge changes after the 1991 reforms, right? Based on the NITI Committee.
Yes. Before that, it was quite protected and controlled. The reforms opened it up, introduced more competition, focused on efficiency and prudential norms.
The core functions are taking deposits, giving loans.
Fund transfer, foreign exchange, advisory services. But a key role highlighted is financial inclusion, extending basic banking to underserved areas and populations.
What are the big challenges mentioned for the banking sector?
Non-performing assets, NPAs, or bad loans is a major one we need to discuss. Also, politico-bureaucratic hurdles, red tape, potential political influence impacting lending or appointments.
Reforms have included technology upgrades, consolidation like the recent PSB mergers.
Right. And the concept of scheduled commercial banks, those listed in the RBI Act's second schedule. They get access to RBI's liquidity facilities, but have obligations like maintaining reserves and regular reporting.
Nationalization back in 69 and 80 had a big impact on inclusion, didn't it?
Definitely. The sources credit it with significantly expanding bank branch networks into rural areas, boosting priority sector lending, and mobilizing deposits.
What about cooperative banks? They seem to serve a specific niche.
They do, often focused on rural communities, small businesses, agriculture. They play a vital role in grassroots financial inclusion. But they face challenges too, governance issues, sometimes political interference, NPAs, and often lagging in technology. They have a dual regulation structure involving RBI and state authorities.
Then there's differentiated bankings, small finance banks, and payment banks.
These were introduced more recently to further financial inclusion. Small finance banks, SFBs, are proper banks. They take deposits and lend, but their focus must be on small businesses, marginal farmers, micro-industries, the unorganized sector. They operate under normal banking regulations.
Examples like Equitas, Ujjivan are mentioned.
Right. Payment banks are more limited. They can take deposits up to a limit, currently Rs 2 lakh per customer, and offer payment remittance services, issue debit cards, but they cannot lend or issue credit cards. Think Airtel Payments Bank. Focuses on transactions and reaching the unbanked digitally.
What about development financial institutions, DFIs?
These are specialized institutions set up to provide long-term finance, often for infrastructure or specific sectors where commercial banks might be hesitant to lend due to longer gestation periods or higher risks.
Like NABARD for agriculture and rural development.
Exactly. SIDB for small industries, MSMEs, XM Bank for export-import finance, and NHB for housing finance. These DFIs play a crucial role in channeling funds to key development areas. Interestingly, NHB and NABARD manage funds like the Urban Rural Infrastructure Development Funds, capitalized partly by commercial banks falling short on their PSL targets.
Microfinance institutions, MFIs, focus on very small loans.
Yes, targeting low-income individuals, often women, to support micro-enterprises, seen as a tool for poverty reduction and empowerment.
And NBFCs, non-banking financial companies.
They provide various financial services like loans and investments, but don't have a full banking license critically. They generally can't accept demand deposits. They are a very diverse group, regulated by RBI and other bodies depending on their specific activities. RBI's DocSH portal helps monitor them.
Neobanks are the new kids on the block.
Essentially digital-only banks, usually partnering with existing licensed banks. No physical branches, focusing on tech-savvy customers, offering innovative services. They're pushing competition and digital adoption.
Okay, let's tackle that big challenge. NPAs, non-performing assets, bad loans.
A loan becomes an NPA when payments of interest or principal are overdue for 90 days or more. It's a major drag on bank profitability and lending capacity.
There are classifications based on how long they've been overdue?
Yes. Standard, performing well. Substandard, NPA for 12 months. Doubtful, NPA for 12 months. And loss, considered uncollectible. Total stressed assets are even broader, including NPAs plus restructured loans and write-offs.
What caused the NPA problem in India, according to the sources?
Multiple factors are cited. A period of aggressive lending during the boom years of the 2000s, followed by economic slowdowns and the global financial crisis. Specific sectoral problems, like in infrastructure or textiles, issues with corporate governance, risk management practices within banks, external pressures, and sometimes banks lending without full information. The scale, measured as NPAs to total loans, became quite significant.
So what's been done to resolve them?
A range of measures. Asset reconstruction companies, ARCs, were set up under the Sarfazi Act to buy NPAs from banks and try to recover value.
Sarfazi itself gave banks more power.
Yes, the Sarfazi Act 2002 empowers banks to enforce security interests, seize and sell collateral without needing to go through lengthy court procedures. A powerful tool. Older schemes like 525 or strategic debt restructuring, SDR, were also tried. A key step was the Asset Quality Review, AQR, in 2015, which forced banks to recognize the true extent of bad loans on their books.
And the Insolvency and Bankruptcy Code, IBC, in 2016.
That was a landmark reform. It created a unified framework and a time-bound process for resolving insolvency for companies. Before IBC, the process was fragmented across different laws and forums, often leading to huge delays. The sources mention winding up could take over 4 years. IBC aims for resolution within 180 days, extendable, creditor-driven, maximizing asset value. It's had a major impact, though challenges with delays in infrastructure remain.
The sources also define a willful defaulter.
That's someone who can repay but chooses not to, or diverts funds, or disposes of assets securing the loan. It's treated more severely than genuine default due to hardship, with penalties like being barred from future finance or directorships.
RBI also introduced a prudential framework for stressed assets in 2019.
Yes, this pushes for early recognition of stress within 30 days of default and requires banks to implement a resolution plan quickly within 180 days, failing which they must refer the case to IBC. It aims to prevent delays in resolution. The resolution frameworks 1.02 and 2.0 were specific temporary relief measures during COVID-19.
And deposit insurance. How are depositors protected?
Through the Deposit Insurance and Credit Guarantee Corporation, DICGC. It provides insurance cover for bank deposits, currently up to Rs 5 lakh per depositor per bank. This is vital for maintaining public confidence, especially for small savers.
Okay, moving beyond banks to the broader financial markets. Capital market versus money market.
Capital market is for long-term funds, trading stocks, equity, and bonds, debt. It connects those needing capital, companies, government, with investors. Includes primary market, new issues, IPOs, and secondary market, trading existing securities. Money market is for short-term funds, usually less than a year.
Instruments in the money market include
Call money, very short-term interbank loans, treasury bills, T-bills, short-term government borrowing, commercial paper, CP, short-term unsecured corporate debt, certificates of deposit, CDs issued by banks, and repos, which we discussed under RBI tools. MIBOR, Mumbai Interbank Offered Rate, is the benchmark rate for this market.
in the capital market.
Stocks, bonds,
Mutual funds, pooled investments managed professionally, debentures, another form of corporate debt, participatory notes, P-notes used by foreign investors indirectly,
specific bond types mentioned are masala bonds.
issued outside India but denominated in Indian rupees, allows Indian entities to raise funds globally while shifting currency risk to the investor.
Green bonds. Debt raised specifically to fund environmentally friendly projects. Funds are earmarked for green initiatives.
Inflation index bonds.
Principal value is linked to an inflation index like CPI, protecting investors' purchasing power.
What about investment vehicles? Mutual funds are common.
AIFs. Alternative investment funds cater to sophisticated investors. They include things like venture capital, private equity, hedge funds, structured into categories based on strategy and risk, higher risk-return potential. ESG funds considering environmental, social, governance factors are also growing.
Sovereign wealth funds. India has one.
Yes, state-owned investment funds. India's is the National Investment and Infrastructure Fund, NIFE, registered as an AIF, focused on long-term capital for infrastructure.
REITs and invites allow investment in.
Real estate, REITs, or infrastructure projects invite peace through tradable units like mutual funds for property or infrastructure assets. And ETFs, exchange-traded funds, are baskets of securities, often tracking an index that trade like stocks.
Who regulates these markets? SEBI.
Securities and Exchange Board of India, SEBI, is the primary regulator for the securities market, established in 1988. Its mandate is investor protection, promoting market development, and regulating intermediaries like brokers.
Appeals against SEBI go to SAT.
Yes, the Securities Appellate Tribunal reviews SEBI's orders to ensure fairness and legality.
Stock exchanges like BSE, NSE provide the trading platform.
Yes, crucial infrastructure for price discovery, liquidity, and capital raising. Gift City in Gujarat is highlighted as India's first international financial services center, IFSC, aiming to be a global hub.
And a demat account is needed to trade electronically.
Yes, it holds your securities in electronic form, making trading faster, safer, and more convenient than physical share certificate.
What about the commodity market?
That's where raw materials, agricultural goods, energy, metals are traded. Important for price discovery and risk management, hedging for producers and consumers. Exchanges like MCX and NCDEX facilitate this.
And central counterparties, CCPs, reduce risk.
Yes, they act as intermediaries in trades, guaranteeing settlement even if one side defaults. They are crucial for market stability, especially in derivatives.
Okay, a vast financial ecosystem. Now let's look outwards. India in the global economy, starting with the balance of payments, BP.
The BP is the systematic record of all economic transactions between residents of India and the rest of the world over a specific period, usually a year. It shows our economic relationship with other countries, vital for assessing financial health and policy making.
Two main components, current account and capital account.
Right. Current account covers trade in goods and services, income flows like profits, interest, dividends, and unilateral transfers like remittances. Capital account tracks flows related to assets and liabilities, FDI, portfolio investments, loans, banking capital.
A current account deficit, CAD, means?
It means the value of imports of goods and services plus net income paid abroad exceeds the value of exports plus net income received. Basically, we're spending more foreign currency than we're earning through current transactions.
Why does India often have a CAD?
Sources mention factors like high imports of oil and gold, sometimes weak global demand hurting exports, and strong domestic demand pulling in imports.
The sources describe India's CAD situation as a mixed bag.
Meaning it fluctuates. It had narrowed significantly in the period mentioned, Q2 FY24, but remains vulnerable to external shocks like oil price spikes or global slowdowns. Structural issues affecting export competitiveness also play a role. Y.V. Reddy's argument about aiming for zero CAD in normal times as a buffer is noted.
How can CAD be managed?
Policy options include fiscal consolidation, reducing government borrowing, monetary policy, RBI adjusting rates to influence capital flows or demand, exchange rate policy, letting the rupee depreciate can make exports cheaper and imports costlier but carries inflation risks, and trade policy, export promotion measures.
The J-curve effect relates to currency devaluation.
Yes, it suggests that after a currency devaluation, the trade deficit might initially worsen because import prices rise immediately while export volumes take time to pick up. Only later, as exports increase and imports decrease, does the trade balance improve. It follows a J-shape over time.
Foreign investments are key on the capital account side, FDI versus FPI.
Foreign direct investment, FDI, is long-term investment involving significant influence or control, often through owning a substantial stake or setting up new operations, greenfield, or acquiring existing ones, brownfield. It's about investing in real, productive assets.
FTI is different.
Foreign portfolio investment, FPI, is investment in financial assets like stocks and bonds. It doesn't typically involve control and is often shorter term, more liquid, sometimes called hot money, as it can flow in and out quickly based on market sentiment, regulated by SEBI.
So FDI is long-term, control-oriented, real assets.
Yeah.
FPI is shorter-term, financial assets, less control.
That's the core distinction. FDI is generally seen as more stable and beneficial for long-term development, bringing capital, technology, jobs, market access, competition.
But attracting FDI to India has challenges mentioned in the sources.
Yes, issues like land acquisition complexities, environmental clearances, sometimes negative perceptions from past controversial projects, bureaucratic hurdles, variations in ease of doing business across states, labor law rigidities, and perhaps not marketing India effectively enough are all cited as challenges.
Government initiatives like PLI schemes, Make in India, National Infrastructure Pipeline, aimed to boost FDI.
Right, trying to create a more attractive environment, incentivize manufacturing, provide infrastructure visibility, and streamline processes. FDI in specific sectors like retail and agriculture are also discussed, weighing potential benefits against concerns.
Indian companies also raise money abroad through ECBs.
External commercial borrowings. These are loans taken by Indian entities from foreign lenders. They offer access to larger pools of capital, potentially lower interest rates, and longer maturities. Regulated by RB Finance Ministry with automatic and approval routes, commercial borrowings form a large part of India's external debt.
ADRS GDRs allow trading Indian shares abroad.
Yes, American or global depository receipts. They represent shares of an Indian company but trade on foreign stock exchanges, making it easier for international investors to invest in Indian firms and for Indian firms to access global capital.
Forex reserves are the country's buffer.
Exactly. Assets held by the RBI in foreign currencies, gold, SDRs, special drawing rights from IMF, and reserve position with the IMF. They are used to manage exchange rate stability, meet external payment obligations, provide confidence to markets, and act as a cushion against external shocks. Foreign currency assets are the largest component for India.
Exchange rates fixed versus flexible.
A fixed rate is pegged by the government, offering stability but limiting monetary policy autonomy and requiring reserves to defend the peg. A flexible or floating rate is determined by market forces, allowing automatic adjustment to shocks and monetary independence, but can be volatile.
India uses a managed float.
Yes, the RBI generally lets the market determine the rupee's value, but intervenes to prevent excessive volatility or speculation. A middle path trying to get benefits of both systems.
Purchasing power parity, PPP, gives a different comparison of economies.
Right. PPP adjusts exchange rates to reflect the actual purchasing power of currencies in their home countries, how much a standard basket of goods costs. It often gives a better comparison of living standards than nominal GDP using market exchange rates, especially for countries with lower price levels like India. India's PPP-based GDP rank is significantly higher than its nominal rank.
Currency convertibility. How easily can rupees be exchanged?
India has current account convertibility. This means freedom for transactions related to trade, services, remittances, travel, etc. But capital account convertibility, freedom to convert for buying, selling assets, investments, large loans, is still restricted or managed.
Why the restriction on capital account convertibility?
Concerns about potential instability. Full convertibility could lead to large, sudden capital outflows, capital flight during times of crisis, increased exchange rate volatility, making it harder for RBI to manage the economy. The risks are seen to outweigh the benefits currently, though gradual liberalization continues, like through the LRS scheme for individuals. The distinction between hard, stable, widely accepted like USD, and soft, less stable currencies is also relevant here.
Trade policy shifted dramatically with the 1991 reforms.
Yes, moving from a relatively closed import substitution model towards a more open, export-oriented one. Reduced tariffs, dismantled controls. The sources contrast different approaches like free trade, fair trade, ethical focus, and open versus closed economies.
India uses various trade agreements, PTAs, FTAs, CPAs.
Yes. Preferential trade agreements offer reduced tariffs on some goods. Free trade agreements aim to eliminate tariffs on most goods and services, covering broader areas. Comprehensive economic partnership agreements are even wider, including investment, competition, IPRs. Countries pursue these often due to slow progress in multilateral WTO talks and to gain competitive advantages in global value chains.
Schemes like RODTEP and TIEs help promote exports.
RODTEP refunds embedded taxes and duties on exported products to make them price competitive. TIEs provides funding support for creating export-related infrastructure.
Okay, final major section. Taxation in India. What makes a good tax system according to the sources?
Principles mentioned include equity or fairness. Those who can pay more should pay more. Simplicity, easy to understand and comply with. Certainty, predictable. Convenience, easy to pay. Economy, low cost of collection. Neutrality, doesn't distort economic decisions unnecessarily. Flexibility and protecting taxpayer rights.
The main types are direct and indirect taxes.
Direct taxes are levied on income or wealth, like personal income tax, corporate tax, paid directly by the person entity earning the income, generally considered progressive. Indirect taxes are levied on goods and services like GST, customs duty, paid indirectly by consumers as part of the price, can be regressive, hitting lower income groups harder as a percentage of their income.
Corporate taxes on company profits. There's also MIT.
Minimum alternate tax. It's a way to ensure companies claiming large deductions still pay some minimum tax based on their book profits. Those sources mention a newer, lower corporate tax rate option exists, but companies choosing it lose eligibility for many deductions, and MAT doesn't apply to them.
Tax reforms are ongoing. The Chilia Committee is mentioned.
Yes, back in 1991, recommending rationalizing subsidies, broadening the tax base, improving direct tax collection.
A big challenge is tax avoidance and evasion, especially cross-border.
Absolutely. India has measures like advanced pricing agreements, APAs, and stricter transfer pricing rules to reduce disputes on international transactions. GAA, the General Anti-Avoidance Rule, targets arrangements made solely to avoid tax without real commercial substance. Schemes to declare black money have also been tried.
The Global BEPS initiative targets multinationals shifting profits.
Base erosion and profit shifting. It's about MNEs exploiting tax rule gaps between countries to artificially shift profits to low or no tax locations. The OECD G20 have a project to counter this.
How has India responded to BEPS?
Implementing an equalization levy, Google tax, on certain digital services provided by non-residents. Strengthening transfer pricing documentation, including country-by-country reporting, CBCR. Renegotiating tax treaties to prevent abuse, like incorporating anti-avoidance clauses, using GAAR, and actively participating in the global discussions around the two-pillar solution.
Transfer pricing itself is
Ensuring that transactions between related companies, like subsidiaries of an MNE, are priced fairly, as if they were between unrelated parties, the arm's-length principle. This prevents artificial profit shifting.
The G20 OECD two-pillar solution is a big global deal.
Pillar 1 aims to reallocate some taxing rights on profits of the largest MNEs to the countries where their customers are located, market jurisdictions, even without a physical presence. Pillar 2 introduces a global minimum corporate tax rate, mentioned as aiming for 15%, to stop the race to the bottom, where countries compete by offering ever lower tax rates.
Turning to domestic indirect taxes, the Goods and Services Tax, GST, was a massive reform in 2017.
Huge, aimed at creating one nation, one tax, one market. It subsumed many central and state indirect taxes into a single, comprehensive, destination-based tax levied on value addition at each stage.
Key features: destination-based dual GST.
Right. Tax accrues to the state where consumption happens. Dual GST means both center, CGST, and state, SGST, levy tax on interstate supplies. For interstate supplies, there's integrated GST, IGST, collected by the center and shared with the destination state. Crucially, there's the input tax credit, ITC mechanism.
Which avoids tax on tax.
Exactly. It allows businesses to claim credit for the GST they paid on their inputs, purchases, reducing the cascading effect of taxes. Other features include threshold exemptions for small businesses and a simpler composition scheme for others.
The GST Council is the governing body.
Yes, a joint forum of the center and states, constitutionally mandated, Article 279A, which makes recommendations on rates, rules, exemptions, etc. Decision-making acquires a 75% majority with specific weightage for center and states votes. Its recommendations are generally followed, especially for rules and rate changes.
The e-way bill system tracks goods movement.
Yes, a digital document required for transporting goods above a certain value aimed at preventing tax evasion during transit.
So what's the verdict on GST's impact so far?
Sources suggest positives include moving towards a unified market, a robust IT backbone, GSTN, an increased tax base, reduced cascading, and improved logistics efficiency. Challenges remain, though: complexity in the structure, compliance burden, especially for smaller businesses, occasional IT glitches, and some volatility in revenue collections.
Room for improvement still.
Yes, suggestions mentioned include simplifying further, perhaps centralized assessments for large taxpayers, more uniformity.
And GST compensation to states was part of the deal.
Yes, a commitment from the center to compensate states for 5 years if their GST revenue growth fell below 14% annually from a base year, funded by a compensation cess on certain luxury certain goods.
Wow. Okay, we have really covered a vast terrain here, from the absolute basics of micro and macro, measuring national income, looking at the deep challenges of poverty, inequality, unemployment.
Then diving into the government's tools planning, fiscal policy, monetary policy.
The whole financial system: banks, markets, NPAs, regulations.
India's connections with the global economy: BOPI, CAD, FDI, exchange rates.
And finally, the complex world of taxation, both domestic with GST and international, with things like BEPS and the global minimum tax.
It really highlights how interconnected everything is, doesn't it? National income figures reflect the context for poverty. Fiscal and monetary policies try to influence growth and stability. Financial markets channel the funds. Global factors impact trade and investment. Taxation affects everything.
Absolutely. This deep dive, drawing just from these sources, hopefully gives you a solid framework for understanding the economic news you read, the policies being debated, and how it all fits together in the Indian context.
It's certainly a dynamic picture, constantly changing.
It really is. And given that ongoing journey trying to balance rapid growth with tackling these deep inequalities, all while navigating a pretty uncertain global environment, it requires constant learning and adaptation. So maybe a final thought to leave you with. Considering all these tools and challenges we've discussed, RBI's inflation focus, government spending, efforts towards inclusive growth, the NPA cleanup, what do you think is the single biggest hurdle India needs to clear to make sure that economic prosperity truly reaches everyone? Something to chew on.